stop scrolling. I need you to hear this. Right now, the S&P 500 is down 7%. The Nasdaq has dropped 10%, and if you turn on any financial news channel, they will tell you the sky is falling. But here's what they will not tell you. The people who built generational wealth in 2009, in 2020, in 2022, they were not watching the news. They were buying. And right now, history is handing you that same exact window. There are 5 specific stocks sitting at a discount today that could look completely different by 2027, but there is also one psychological trap that is about to swallow millions of investors whole, and most people have no idea it is happening to them right now. We will get to that trap in a moment. First, let us destroy the narrative. The word everyone keeps using is crash. It is on every headline, every group chat, every dinner table conversation. But I want you to pause and ask a simple question. What does that word actually mean? Because there's a massive difference between a crash and a correction, and confusing the two is exactly how people lose money they didn't have to lose. Here is what is actually driving this pullback. Geopolitical tensions are pushing oil prices higher. Inflation is still refusing to cool down cleanly. The Federal Reserve is holding interest rates between 3.5% and 3.75%, with zero indication of cuts anytime soon. That is pressure, real pressure. But pressure is not collapse. A crash is a structural breakdown of the economy. A correction is the market taking a breath, resetting, clearing out the excess. And right now, every single indicator points to correction. Here is the data that matters. In the last 40 years, the S&P 500 has experienced over 30 corrections of 10% or more. Every single one was followed by a full recovery. Not most of them, all of them. So this is not a disaster. This is a pattern. And one of the stocks I'm about to show you has outperformed the market after every single correction in the past 20 years. We will get there, but first, let's talk about the trap.
Here is something no one in finance wants to admit. The market does not destroy most investors. Their own brain does. There is a concept in behavioral psychology called loss aversion. Studies have shown that the emotional pain of losing $100 is roughly twice as powerful as the joy of gaining $100. Think about that. Losing hurts twice as much as winning feels good. And when the market drops, that pain triggers something ancient in your brain, the survival instinct. The same instinct that kept your ancestors alive when there was a predator in the forest. Your brain sees red on a screen and it screams one word: run. This is called herd mentality. When everyone around you is selling, your brain interprets that as a signal of danger, even if the fundamentals say otherwise, even if logic tells you to stay. The fear wins, and that fear has a name in investing. It is called panic selling, and it has destroyed more wealth than any market correction ever could. Here is a story that makes this real. His name is Alex, 28 years old, software engineer. He built a portfolio of $15,000 over 2 years. Smart picks, patient approach. Then March 2026 happened. His portfolio dropped to $12,800, over $2,000 gone on paper. And in that moment, his brain did not say, "Stay calm." It said, "Get out." So Alex sold everything. He told himself it was the smart move. He would buy back in when things settled, when the fear went away, when it felt safe again. 6 weeks later, the market had fully recovered. The 5 stocks he sold were up between 12 and 18%, and Alex was sitting in cash, watching the recovery happen without him. He did not lose because the market fell. He lost because his brain lied to him at the worst possible moment. Here's the rewind line. The market does not punish weakness. It punishes decisions made in fear. And that one decision, made in 6 seconds of panic, cost Alex more than the correction ever would have. Now, let me show you the other side of that story.
Because the math here is undeniable. Every time the market has dropped 10% or more, the average recovery within 12 months has been plus 15%. Not occasionally, on average. And the investors who stayed in captured all of it. The ones who sold missed the best days. And here's the part most people never calculate. Studies show that missing just the 10 best trading days in any given decade cuts your total returns by more than half. 10 days out of 3,600. That's how fragile your gains are when you keep stepping in and out of the market, trying to time it perfectly. The biggest single-day gains in stock market history did not happen during stable, calm periods. They happened right after the steepest drops, right when fear was at its highest, right when the average investor had already sold. Wealth is not built when the market is climbing and everyone feels confident. Wealth is built in the moments when most people are too scared to act. This is one of those moments. And these 5 stocks are specifically positioned to capture the recovery. One of them in particular, I've been saving for last, because the smart money moving into it right now is unlike anything I have seen in a standard correction. Keep watching.
I want to be clear about the selection process here. Not hype, not trends, not what is popular on financial social media. 3 hard criteria only. Correction-resistant revenue, rock-solid long-term fundamentals, meaningful upside when the recovery lands. Every single stock on this list passes all 3 filters. And pay attention to the order. I built this list with intention. Each stock is stronger than the one before it. Stock number 1, Amazon. Currently down roughly 11% from its recent high. And here is the misunderstanding that keeps most people from seeing this clearly. Amazon is not a shopping website. It has not been for years. Amazon Web Services is infrastructure. It is the foundation that AI companies run on, that banks operate on, that hospitals store patient data on. Entire governments rely on it. AWS revenue has grown every single quarter for the past decade. Not the stock, the actual business revenue. Even when the share price dropped, even during every previous correction, the underlying machine kept printing money. When you buy Amazon at a discount right now, you are not buying a retailer, you are buying critical global infrastructure at a sale price. And Amazon has never stayed down. Not in 2018, not in 2020, not in 2022. This dip is no different. Stock number 2, Costco. And I want you to reframe how you think about this company before I explain it. On the surface, it sounds boring. It is a warehouse store. But here's what actually makes Costco extraordinary. The membership model creates something almost no other business in the world has. A customer who paid to walk through your door. Costco members pay annually for the privilege of shopping there, and renewal rates sit above 90%. That means when a recession hits and people cut every luxury in their life, they do not cut Costco. They cut the things that cost them money. Costco is the thing that saves them money. And here's the pattern most analysts actually confirm. When economic pressure builds, Costco foot traffic increases. Their business gets stronger when the economy gets weaker. That is not a coincidence. That is a moat. And right now you can step over it for less than you could 3 months ago. Stock number 3, Johnson & Johnson. Let me ask you something direct. When was the last time someone said, you know what, the market is down this quarter, I'm going to skip my chemotherapy, or my insulin, or my blood pressure medication? It has never happened. It will never happen. Healthcare demand is completely disconnected from market sentiment. People do not choose whether to be sick based on what Jerome Powell says about interest rates. Johnson & Johnson has paid a growing dividend for over 60 consecutive years. More than 6 decades of uninterrupted cash returning to shareholders, regardless of what the market was doing. When everything else in your portfolio was volatile, this stock functions like an anchor, stable, predictable, profitable. And today, it's priced lower than it was 90 days ago for no fundamental reason. That is the definition of an opportunity. Stock number 4, Verizon. Most people skip this one.
And that is exactly why it deserves your attention. Stop thinking about Verizon as a phone company. Think about it as a toll booth on a highway that every single person in America uses every single day. Every data plan, every mobile stream, every connected device, every business running cloud applications over cellular, Verizon collects that fee every month, without exception. Whether the economy is growing or contracting, whether interest rates are rising or falling, the cash flow is consistent. The dividend yield is strong, and the business model is almost impossible to meaningfully disrupt in any short time horizon. In a correction, what is the most valuable thing in the market? Not growth promises, not future projections. Consistent, reliable, real cash flow. Boring and profitable will always outlast exciting and volatile when you are building serious long-term wealth. Stock number 5, Blackstone. I need you to put down whatever else you were thinking about and focus here, because this is the one. This is the stock that institutional investors and high net worth allocators are quietly positioning in right now, and most retail investors have absolutely no idea. Blackstone is not a traditional bank. It is not a hedge fund. It is one of the most powerful private credit and alternative asset management firms ever built. And here is why this correction is actually an opportunity for Blackstone specifically. When traditional banks feel nervous, they pull back, they tighten lending standards, they reduce exposure, they retreat. Blackstone does the opposite. Blackstone moves into the exact spaces the banks leave empty. Private credit is currently the fastest growing segment in global finance, not one of the fastest, the fastest. And Blackstone is not just participating in that growth, it is leading it. The institutional money moving into this company right now is not retail speculation. It is calculated, strategic, quiet, and the window where you can enter alongside it will not stay open indefinitely. If you take one single idea from this video, let it be this one. Do not let the noise of the correction make you miss what the smart money is actually doing.
Now here is where most people make their second mistake. They find the right stocks, and then they ruin it with the wrong execution. Knowing what to buy is maybe 10% of this game. Knowing how to buy is everything else. Do not try to call the bottom. I cannot do it. No analyst on television can do it. Warren Buffett cannot do it consistently. The bottom is only obvious after it is already passed. What actually works is a strategy called dollar cost averaging, and the concept is almost embarrassingly simple. Take the total amount you want to invest, divide it into 3 or 4 equal parts. Buy the first part today, buy the second part in 30 days, buy the third part 30 days after that. That is it. Here is why this is powerful. You stop needing to be perfectly right about timing. When the price drops further, your next purchase automatically buys more shares for the same money. When it recovers, your earlier purchases are already gaining. You smooth out the volatility, you remove the psychological pressure of the single decision, and you give yourself the one ingredient that every wealthy long-term investor shares: time in the market, not timing the market. Smart investors do not sit and wait for certainty. Certainty never arrives. They build a system, they execute consistently, and they let the math do the work over time. The market has always rewarded that approach. It always will. Let me bring you back to something I said at the very start of this video. The people who built real wealth in 2009, in 2020, in 2022, they were not watching the news. They were buying. Now it is 2026, and history is running the same script. In 2027, there will be 2 types of people looking back at this exact moment. The first type let the fear win. They sold, they waited, they missed the recovery, and they will spend the next several years telling themselves the timing just was not right. The second type understood what was actually happening. They recognized the psychology, they identified the opportunity, they took action while everyone else was running. And by 2027, the difference between those 2 people will not be intelligence, it will not be luck, it will be one decision, made right now, in this exact window. Fear is loud. Regret is permanent. The stocks are discounted today, the door is open today, and the version of you that exists in 2027 is being shaped right now by what you decide to do next. So here is my question to you. Which one of these 5 stocks would you start with? Drop it in the comments below. I read every single one. And if you want the next 5 stocks I am tracking for the second half of 2026, subscribe right now, because that video drops very soon, and you do not want to be the person who missed it twice.